Hello traders, Gary Wagner here, just about 10:20 in Honolulu, 4:20 in New York. It is Monday, 8th day of May, 2017, and this is the Daily Report for Gold and Silver. Nominal moves in the precious metals markets. On deeper, more detailed look, you'll see that it was really a strong U.S. dollar that curtailed any kind of real upside movement. When we look at most active futures, 12.2620. That is our current price, putting it off about 70 cents on the day. The low 12.21 and the high 12.36 on the day. As you can see from this small weekly chart at the bottom left-hand side, we do have a slight uptick on our weekly chart, but it is only Monday. Spot gold currently trading also at 12.26. Net change down about $1.80. Highs and lows approximately the same. Over to silver. The carnage continues. Although the market is only trading off by about 2 cents on the day at 16.25, the low 16.24 tells you that the selling pressure has come in as we go into the close of the day, and the high on the day is 16.45. Interesting action on the first day of the week following the largest single week drop in 2017. We do have a small green candle, but traders, this is only Monday. The market did make a lower low on the week, and you can see that here. Low today, roughly 12.21 on the nose, traded to a high of 12.36. And we closed at 12.26 after opening this morning roughly at about 12.22. As we have talked about on Friday's show as well as in our opening letter, the key to all of the most recent activity is to discern whether or not this most recent price decline is a simple correction from the rally that came just before it, or if it is signaling the potential of a key reversal in which once prices hit 1,300 per ounce, we moved from a bullish scenario or bullish model to a bearish model. Of course, it will be a matter of seeing whether or not this market effectively finds support and trades above this high. That would give us technical confirmation that this most recent sell-off was simply a correction, or if the market continues to break lower, breaking below 78, and in fact we get a lower low, and that would necessitate a breach below 1200 or a breach below 1190 for these recent lows. That is the only way on a technical basis we can ascertain with any kind of certainty that the market's recent move was a correction, or B, a pivot point in which we went from a bull scenario to a bearish scenario. There are some technical studies that we can implement to determine strength of trend and potential pivot points. One of the key technical studies that we have been looking at is our Fibonacci retracement. And to that end, we have created a single fib retracement that really covers the second leg of this rally in 2017. It contains this shorter fib retracement sequence, and we have clearly broken below a 61% retracement, which is absolutely bodes well for the bears and not for the bullish faction. But we have yet to break a 78% retracement, because that is kind of a line in the sand. If the market effectively trades and closes below this particular price point, it is very difficult to make a case for a bullish model, calling this recent sell-off a mere correction. It could easily at that point be construed as a key reversal in which we went from a bull market to a bear market. And traders, although both gold and silver have come under dramatic selling pressure over the last 3 weeks, it has been silver that has really been selling off in a much greater extent than gold. The percentage drawdowns have been greater, and when we look at the gold-silver ratio, we can see that widening, with it taking more ounces of silver to purchase a single ounce of gold. This is a daily chart of silver. It is in Japanese average format. And the one thing that we can see is, unlike gold, which is still tracking and trading above a 78% retracement of the yearly range, we are below the 78% retracement on silver, just slightly. Which takes us to our gold-silver ratio. We're looking at a gold-silver ratio. This is based off of physical or spot pricing. We can see that there was a gain today, a widening of that ratio now at 75.5, and I do expect that particular rise to continue. In other markets that we follow, U.S. equities managed to eke out fractional gains on the day. Dow Jones Industrial Average trading above 21,000, 21,012. Net change under 0.1%. Standard & Poor's much the same, although we're seeing positive prints or green prints. We are at 23.9938. And as you can see, net change on the day is 0.00. And lastly, the NASDAQ index, again, basically closing unchanged on the day, but closing above 6,100 at 6,100.93. Now, it's been all about the U.S. dollar, as that has had some real strength today, closing up about 0.5% on the day at 99.01. U.S. equities continue to have solid footing. They are not giving up any kind of room, although we're seeing a contraction in terms of weekly gains. We are still seeing these markets week in and week out close at new record highs. We are looking at the NASDAQ Composite, our weekly chart. You can see that we are at 6102. I believe that 6102 was the highest point that the composite index traded to last week. This week already we have 6106 as a new high, intra-week high. So the key is whether or not this particular index will hold in this area and close at a new record high this week. All things being equal, I believe that that is quite possible. I would look for the NASDAQ to continue to gain value. And traders, lastly, do want to look at the U.S. dollar. Very, very strong performance today, moving up roughly 0.5% in value, 99.04. When we look at our daily chart, which is what I do have up on the screen currently, what we can see is the longer term moving average, and this is our 200-day, the dashed red line, our shorter term 50-day moving average. We can absolutely see that this 200-day moving average has really served as a resistance area, creating technical headwinds for the dollar, and on each occasion that the dollar attempted to move up, it stalled right below or just above this area. In the case of these two red candles that appear above it, the market opened above the 200-day moving average, but on both occasions closed below it. Today's dynamic move is certainly an engulfing bullish, very, very small candle on Friday, very large candle today. We would have to see the market effectively trade and close above the 200-day moving average. If in fact that happened, we would look for the market to move back towards the 50-day moving average. Traders, as I spoke about in detail on Friday's show and carried that conversation over to today's show, we are at a critical price point in terms of where gold is sitting. If we can see some firmness in gold prices this week and a close above 1217, that is the 78% retracement of the most recent rally, then a model can be certainly made for this recent sell-off to be corrective in nature rather than a key reversal from a bull market to a bear market. Now, the net result of ascertaining which assumption is correct cannot be achieved on a technical basis until we take out a higher high or a lower low. Either one of them would signal either a continuation of the bull or a movement from bull to bear market. My sense is that we could find some firmness in the market. Although we've been under pressure, my sense is that as long as we hold above 1217, on a technical basis, there's a real case to be made that we could in fact find some support in this area. This has been Gary Wagner wishing you as always good trading. We will talk to you tomorrow for another daily update and review. Bye-bye.